Look closely at this exact millisecond. A thumb strikes the Pay button on a glowing smartphone application. Many view this transaction as a simple, finalized sales credit on the profit and loss statement. In reality, marketing acts as a highly regulated, financially measurable mechanism that dictates top-line revenue and operational solvency. To understand how this works, we will keep this single mobile conversion frozen and deconstruct its exact financial and statutory anatomy. The macroeconomic scale of these M-business platforms is evident in massive institutional capitalization events, like the Swiggy IPO listing. A single mobile click triggers a massive hidden architecture of tax APIs, data privacy checks, and deferred liability ledgers. Traditional physical exchange functions were governed simply by the Sale of Goods Act 1930. The transition to e-tailing and M-business removes physical and geographical limitations, forcing accountants to manage borderless cloud environments. By eliminating physical intermediaries, digital marketing shifts the financial burden of supply chain functions, like warehousing and transportation, directly onto the company's internal logistics budget. This shift requires a corresponding change in how auditors evaluate internal controls over marketing budgets. Marketing has become the interface where consumer psychology is translated into rigorous financial accountability. Before the app can process its first transaction, the enterprise must allocate massive capital to build the M-business architecture. Classification of these development costs is strictly governed by IND AS 38. Under these rules, costs are splitting into two paths. General research flows into immediate expenses, while successful UI and coding development stacks into the intangible assets column of the balance sheet. These capitalized assets are then amortized over their useful economic life. The Information Technology Act 2000 provides the necessary statutory backing, granting these digital storefronts and electronic contracts legal validity. This digital infrastructure scales rapidly as mobile wallets and UPI integrate with the physical retail consumer base. Failing to properly capitalize this digital infrastructure under IND AS 38 results in the artificial depression of the enterprise's declared net profits. In the split second before the user clicks Pay, the app is executing the market information function. The platform uses location-based services to perform algorithmic profiling and set dynamic prices. This data harvest is subject to the Digital Personal Data Protection Act 2023. To secure verifiable consent, the system uses a consent manager. If a geolocation ping attempts to reach the CRM database without digital authorization, the gateway blocks it. Violating this compliance structure triggers a contingent liability. Fines for unauthorized processing can reach 250 crore rupees. Statutory auditors use Standard on Auditing 315 to assess these cybersecurity environments and prevent material financial misstatements. A consumer data profile is a highly volatile statutory liability. The transaction processes for 1,000 rupees, and the app awards the user 100 loyalty coins. This is relationship marketing, designed to maximize customer lifetime value. The accountant cannot legally book the entire 1,000 rupees as immediate top-line revenue. Under IND AS 115, the revenue splits. 900 rupees flows into recognized revenue, while the value assigned to the loyalty coins drops into a deferred revenue liability pool. This pool remains a current liability on the balance sheet until the points are redeemed or statutorily expire. Management accountants balance these liabilities against the return on marketing investment to justify the initial customer acquisition cost. Relationship marketing algorithms intentionally delay immediate cash recognition to engineer predictable, long-term corporate cash flows. Once the digital transaction clears, it triggers the physical functions of warehousing and transportation. The ERP system must simultaneously calculate the place of supply to apply the correct IGST or CGST and SGST rates. To be legally valid, this data must be pushed to the invoice registration portal for a GST e-invoice. If the app labels this transaction as a carbon-neutral delivery, it is engaging in green marketing. CCPA greenwashing guidelines classify unverified eco-friendly claims as deceptive trade practices. Verified green product positioning, such as the Tata Nexon.EV, aligns promotional claims with government incentives like FAME subsidies. Auditors must verify these sustainability claims for mandatory business responsibility and sustainability reporting. When unverified ecological claims are classified as deceptive by the CCPA, the enterprise faces immediate financial penalties and a mandatory legal requirement to recall all misleadingly labeled inventory from the market. Zooming out, marketing appears as the socio-economic nexus where consumer demand and operational capability intersect. This integration is visible in models like ITC's eChopal, which connects physical supply logistics and rural microenvironments within a single financial structure. In our transaction, a single tap capitalized an asset, navigated a privacy firewall, deferred a liability, and generated a tax invoice. Modern accounting practice requires the mathematical auditing of the interconnected algorithms governing these digital ecosystems, replacing the manual verification of paper receipts. Mastering this convergence of technology, tax, and law ensures an enterprise scales profitably while mitigating the legal liabilities of the modern digital economy.